Well, welcome, everyone. We're delighted to have you all here for our presentation of Wisconsin's second in the series called Wisconsin 2050, Pioneering the Future. Tonight, Liaquat Ahmed is here with us to speak about lessons from the Depression. There are some other very important people that are here, and at this point what I'd like to do is to introduce Lori Keating-Heineman, the secretary, Governor Doyle's secretary of the Department of Financial Institutions. She has had her appointment since the governor was elected in 2003, prior to an 18-year career in the banking and securities industries. And Lori will give us a little bit of a Wisconsin perspective on banking and financial institutions in the state and introduce our speaker. We're very honored to have her join us today, Lori Keating-Heineman.
Well, thank you very much. I'm really honored to be here, and I did not know when I took this position back in 2003 it would be quite the challenge that it has become, but indeed it is. Tonight I've been asked to talk briefly about the state of Wisconsin's banking environment and to introduce our highly esteemed speaker. First, because I am the Commissioner of Banking for the state, I have to tell you that our banks are not exempt from the economic downturn. Well, the majority of our banks, which we regulate 217 state chartered banks in the state, well, the majority of them remain strong. Many are experiencing a high percent of loan delinquencies caused by the decline in real estate values and the increase in unemployment levels, which I'm sure is a surprise to none of you. Our average capital ratio, which is basically the capital in the bank divided by the total assets, is a respectable 9.8% and is actually better than the overall national average of all banks in the United States. However, our bank earnings are down. 1 out of 5 banks are now reporting negative earnings. Earnings have been under pressure due to the need for increased loan losses, because when a loss is taken, they have to put more in their loan loss reserves, tight net interest margins, and the increased cost of FDIC insurance premiums. The weakening economy has also reduced the number of qualified borrowers and has resulted in increased scrutiny by both the state and the federal regulators. In Wisconsin, we actually partner with the Federal Reserve Banks of Chicago and the one in Minneapolis to oversee the operations of our Fed member banks. And I know you're going to hear a little bit about the Fed today, so I thought I'd mention that. But we also partner with the FDIC as we co-examine many of the banks throughout the state of Wisconsin. I will point out, because I'm kind of a champion for the community bankers, is that the life's work of many of our bankers in the state is being challenged by the cost of paying for the excesses of some too-big-to-fail institutions. Wall Street is impacting Main Street, and the result is a tightening of credit on businesses in our state at a time when the funding is needed the most. So, as it was asked a little bit earlier, how did we get here? And that's what tonight's author, Liaquat Ahmed, is here to talk about. Quoted just over a year ago, Mr. Ahmed said that nothing brings home the fragility of the banking system or the potency of the financial crisis more vividly than writing about these issues from the eye of the storm. These words really ring true today as our country moves forward with the repair and the recovery of our global financial system. You know, last year, I believe Mr. Ahmed had a pretty busy year, it sounds like, from looking on your reviews on the website. When he was putting his finishing touches on his book, Lords of Finance, The Bankers Who Broke the World, he talked about the book being about a story of 4 central bankers in the years after World War I, and of what Mr. Ahmed calls the seminal economic event of the last century, the unprecedented breakdown of the global economy, or what is now known as the Great Depression. Mr. Ahmed's book, which is his first, I believe, has been universally praised, and it has become a bestseller. The book has also won the Spears Book Award for the Best Financial History Book of the Year. Mr. Ahmed will tell us tonight if he saw things coming, what he knew and when he knew it, and better yet, what he thinks will lie ahead. Known as a lover of words, a master storyteller, and a historian, Mr. Ahmed is all of these. But he has also been a professional investment manager for the past 25 years. He has worked at the World Bank in Washington, D.C. He served as the chief executive of a New York investment partnership, and he is currently not only an advisor to investment groups, but a director of the Aspen Insurance Company, and is on the board of trustees for the very highly respected Brookings Institute. So with that, I would like to bring up Mr. Ahmed, who will talk about his book, Lords of Finance, The Bankers Who Broke the World.
Well, thank you for those kind words, Secretary Heinemann. And thank you to the Academy for inviting me to speak. I should just actually put one issue to rest, which is I started writing this book about 4 or 5 years ago, and it was published in January this year. And when it came out, a lot of my friends said, God, you know, you must be some sort of genius. You figured this out 4 or 5 years ago. And they would always then end up by saying, but if you'd figured it out that we were going to have this crash, why didn't you give us a call and let us know? So I didn't figure it out. We've just been through the worst financial crisis since the Great Depression. It may be of little comfort to know that financial crises are nothing new. Indeed, the first financial crisis, first recorded financial crisis, occurred in AD 33, when there was a run on the imperial banking system, and the Emperor Tiberius had to inject 1 million gold pieces to stabilize the Roman banking system. Not only have they been around for a very long time, but there have been a lot of them. In 1721, we had a thing called the South Sea Bubble. And that was the first time the word bubble was used to describe an out-of-control financial mania. But since then, there have been, depending how you count it, anywhere from 40 to 50 different financial booms and crises. So I suppose the good news is that we've always recovered, because here we are. I suppose the bad news is that we keep on making the same mistakes over and over again. The frequency of these financial crises varies. Starting from the early 19th century and right through to the mid-20th century, they seem to occur every 9 to 10 years. In fact, if you're a reader of the New Yorker, there was an article, I think not last week's, but the weeks before, which described someone who's sort of an expert in financial cycles, and he computed they occurred precisely every 8.6 years. The system then went dormant in the 1950s and 60s. And then suddenly in the early 1980s, the volcano seemed to reactivate. And we got a sequence of crises. We got 1982, emerging market crisis. 1987, the stock market collapse. 1990, the S&L problem. 1994, Mexico and the peso crisis. 1997, 1998 was the Asian crisis, the Russian default and long-term capital. And 2000 was the tech bubble. So first of all, it looked as if the frequency of these crises had increased, and we were getting them every three to 4 years. And that's when I became interested. I was in the investment management industry, and I began to read up about past crises in order to understand, what drives them, why they start, how they develop, what to do about them. And there's no better place or there's nothing that provides as much sort of food for thought as the mother of all crises, which is the Great Depression that started in 1929. Today, I'm not going to talk very much about my book. I'm going to really try to focus on the parallels between what happened then and what's just happened. And I'll divide the chronology into three areas: the lead-up, the handling of the crisis, and the recovery. So first, the lead-up. The similarities in the lead-up to what has happened just now and what happened in 1929 are eerie. In both cases, we had a bubble. Then it was in the stock market. This time it was in real estate. In both cases, the bubble was created by a mistake in Fed policy, specifically over easy credit. In both cases, in my view, the mistake was exacerbated, if not caused, by a malfunctioning in the international financial system. Let me spend a couple of moments on this. In the 1920s, the problem was between Europe and the US. Many people forget that 1929 occurred only 10 years after the end of the First World War. The most expensive, costly war in history that essentially bankrupted Europe. For 4 years, the three major European powers, Britain, France, and Germany, spent 50% of their GDP per year fighting this sort of pointless war. They financed it by borrowing massive amounts, both from their own citizens and from the US, in the case of Britain and France, and ultimately by printing money. So they basically destroyed their financial system. In the 10 years after 1919, Europe was trying to rebuild itself. And in order to do that, the US kept credit easy because it needed Europe needed foreign financing in order to reconstruct. And the Fed found itself with a dilemma. It had to keep credit easy in order to rebuild Europe. That easy credit provoked a bubble in the stock market. And as usual, when the Fed's trying to do too many things, it accomplished neither. So the easy credit designed to essentially revive Europe after the First World War was what provoked the stock market bubble. The more recent crisis, or this recent 10 years, the bubble was associated with a slightly different imbalance. And the imbalance was between Asia and the US. And there were two mechanisms that happened. Essentially, beginning in the early part of this decade, Asian currencies were undervalued. China embarked on a massive export push. The other Asian countries, in response to the Asian crisis of 1997, decided that they wanted to accumulate a vast reservoir of dollars. They basically said, we never want to get into this position again. And so they went out of their way to accumulate a reservoir of US dollars. In order to do that, they undervalued their currencies and pushed exports out. That did two things. It, one, confused the Fed. What happened was that because of this export push from Asia, inflation was unusually low because the Asian countries were underpricing their goods. The Fed mistook the low inflation as a symptom of a domestic economy that was running out of steam. So put its foot on the accelerator. In fact, what was happening was we had a once-in-a-lifetime expansion in the supply of goods and services coming out of Asia. If you like, it was good deflation, and the Fed was worried about what it thought would be bad deflation. The second thing that happened was that the accumulation of dollars in the hands of Asian central banks overwhelmed the capacity of the financial system to handle it. So essentially, these dollars were put into financial institutions who then channeled them to, ran out of lending opportunities and channeled them into the worst sorts of lending, made some very poor lending decisions. So the combination of an over-easy Fed and a massive amount of dollars swirling around the financial system provided the fuel for the stock market, for the real estate bubble. To go back to the story, in both cases, we had the same debate about how to react to the bubbles. During the real estate bubble that was occurring at the early part of this decade, Alan Greenspan, the chairman of the Fed, argued 4 things. One, that it was impossible for the Fed to identify bubbles ex ante, that it could only tell if something was a bubble ex post, once it burst. Secondly, that bubbles are an inherent sort of part of a dynamic capitalist system, a product more of human psychology than easy credit, and there was nothing the Fed could do about it. Thirdly, that if he tried to do anything about it, he would be overstepping his mandate and would get himself into a lot of political hot water. And fourthly, that the side effects of trying to deal with the bubble, side effects of the medicine, would be worse than the disease, and that it was more efficient and less costly to deal with the after effects, to, in effect, let the bubble burst, burn itself out, and burst, and then deal with the consequences. Every one of those arguments surfaced within the Federal Reserve in the 1920s, so there was nothing new, and they made exactly the same decision. They made the same calculation that they would step aside and let it burn it, let it, must learn not to mix my metaphors when I talk about bubbles, but let itself blow up. In both cases, both in the 1920s and now, we had excess leverage. In the 1920s, there was development of what were known as investment trusts, which are really like leveraged closed-end funds. And there was a lot of leverage by a group of traders on Wall Street known as pool operators, who were like the hedge fund managers of the era, who borrowed extensively in the broker loan market. And in those days, if you wanted to buy on margin, you only had to put 10 cents down, and you could borrow the other 90 cents and buy $1 of stock. Recently, the leverage has occurred in the financial system, and in particular, what has come to be known as the shadow banking system. So what is this shadow banking system? If you take the total size of banks in the US, they amount to about $10 trillion, compared to a GDP of about 15. In addition, though, to those banks, there are a whole series of other institutions that act like banks, but are not called banks. Now, I'll give you an example that you all use, which is money market funds. What do money market funds do? You deposit your money in the money market fund. You often have check writing privileges. You can withdraw your money when you want to. And what does the money market fund do? It invests that money in a whole series of investments, exactly like a bank does. Total size of money market funds is somewhere between $3 and $4 trillion. So it's almost half the size of the banking system. In addition, we had investment banks that operated like banks. They borrowed short-term and bought long-term assets. Total size of the balance sheet of investment banks was another 3 to 4 trillion. All of these institutions operated like banks without 2 things. One is the regulation that banks are subject to, and in particular the capital adequacy requirements that banks are subject to, and secondly, without the sort of oversight of regulators looking at what they were doing. And this shadow banking system became the most vulnerable part of the financial system. Okay, so in both cases we had a bubble. In both cases, as they always do, the bubbles burst. And in both cases, the bursting bubble led to a banking crisis. In the 1920s, it was a conventional banking crisis. You remember those grainy black and white photographs of people lining up outside banks to take their money out. That was in the days before deposit insurance. Now that we have deposit insurance, there was very little of that, although we did get some cases. We got a run on a bank in California called IndyMac. We got a run on a UK bank called Northern Rock. We got a run on a Hong Kong bank called Bank of East Asia. This time, we had a run on the shadow banking system, and it was actually more insidious and more dramatic, because the shadow banking system, aside from money market funds, largely finances itself through wholesale sources of money, not retail sources of money. And the run occurred, essentially it was a digital run. Institutions got on their computers and with a click of a mouse pulled out hundreds of millions of dollars out of financial institutions. So we've had a banking crisis. Like all financial crises, well, all financial crises seem to throw up a signature crook. In the 1920s, or this time, the signature crook is a man by the name of Bernie Madoff. You've probably been reading about Bernie's exploits. The Bernie Madoff of the 1920s was a man by the name of Ivar Kreuger.